Hello, good evening, and welcome to Unacademy IAS, a one-stop destination for all the English medium civil services aspirants. Welcome to another session in phase 2 of Conquer Prelims 2025. And this is the second lecture wherein we are covering important static concepts from the subject of Indian economy. Yesterday, we covered important concepts again from Indian economy. Today is the continuation. We will cover many more other concepts again related to static portion. Now, before I start the discussion, here are certain very important things to make a note of. I'll be using the PPT and lot of the students in the comment section will keep on asking me for the PPT. Whatever PPT I've used in the last session and even this session, it will be uploaded in my Telegram channel. All you need to do is scan the QR code, join the Telegram channel, and you will be able to download. And point number 2, tomorrow and day after tomorrow, Mukesh Jha sir will be taking up important static concepts from the subject of geography. Before I start the discussion, there is a very important announcement for the aspirants aiming to clear the Civil Services Examination 2026. If you want to subscribe to a program now, the program is available at a price of 24,999. And if you use the IAS English code, you will get 6 months of free extension without having to pay additional single rupee. Those who are interested, click on the link provided in the description below. Now, let me start. The first concept, the first and second both related to food distribution, that is the Public Distribution System and National Food Security Act. The Government of India post independence has been implementing different programs where food grains are being distributed for a certain number of beneficiaries. But if you strictly speak about the model of a public distribution system, is it introduced or was it introduced post independence or was it present even before independence? It was present even before independence. Later on, Government of India basically realized that they are providing the benefits universally, that is, they are providing benefits to everybody using the ration shops or fair price shops. And essentially that is called as a universal transfer of benefits. In 1990s, Government of India revamped this particular structure. Initially, we called this as RPDS, revamped public distribution system, and post 97 and 98 started calling this as targeted public distribution system. And later on in 2013, Government of India introduced a piece of legislation called as National Food Security Act. Initially bill, then became an act, and that provided legal entitlement of food grains to more than 81 crore people covered under ENFSA. Now first let me talk about PDS and then we can understand the concept or the provisions of ENFSA. The public distribution system essentially refers to network of ration shops. It refers to network of the ration shops or fair price shops using which the government is identifying the beneficiaries and distributing the food grains. Now, how do we identify the beneficiaries? Today, if a beneficiary wants to avail the food grains under, let's say, Pradhan Mantri Garib Kalyan Anna Yojana, they will have to go to the ration shop, authenticate themselves. For example, they will provide the thumbprint or the fingerprint, and using Aadhaar, we will be able to identify this as a beneficiary or not. So, essentially what has happened here is, over a period of time, we have developed these network of shops, fair price shops, and using these fair price shops, we are identifying and distributing the food grains. That is called as a public distribution system. But what are the stages in the public distribution system? What are the important phases in the public distribution system? Please make a note of all of this. The step number 1 is, from the farmer, the central government through the agencies such as a Food Corporation of India will procure the food grain. Now, if UPSC will ask you, is it always that Food Corporation of India alone will procure the food grain? Your answer should be no. Along with FCI, even the state government agencies are allowed to procure food grain. There are many other agencies. Reason being, there are two systems of procurement. One is called as a centralized system of procurement, and the obvious second one will be decentralized system of procurement. What happens in a centralized procurement? The FCI, Food Corporation of India, and let's say the state government agencies will procure all the food grain is called as a central pool. All of these food grains is called as central pool. FCI will procure and store the food grain. State government agencies will procure, hand it over to FCI. All of this is called as central pool. From the central pool now, food grains would be allocated to different states. A different state allocation will be done. And for the state government agencies which are involved in this procurement, center will basically provide certain commission. This is centralized procurement. Whereas in case of decentralized procurement, it will be the state government agencies which will procure and also distribute the food grains. Right? They will procure and distribute the food grain. So, step number 1, procurement happens. Step number 2, food grains are allocated to respective state governments. State governments will identify the beneficiary and through the fair price shops, through the ration shops or fair price shops will distribute the food grains to the beneficiaries. And mind you, I'll reiterate this again, repeat this again. Center will simply allocate food grain. Center will decide how many beneficiaries will be there in a particular state. It is the duty of the state government to use multiple parameters to identify who will be the covered beneficiary. Because under the concept right now used, there is a concept of a quota. Center based on various parameters, again mainly the population of the census of 2011 will determine how many beneficiaries would be there in each of the states. That is decided by the center. But whether X is a beneficiary, Y is a beneficiary or Z is a beneficiary, it is decided by the state government. Now many of you will basically say, but sir, in my state there is a different scheme. In my state I get more food grain. In my state free food grain, right? In my state 10 kgs. Whatever the number is, logic is very simple. Center will bear the burden according to what has been announcement done by the center. If the center simply says, I am going to provide only 5 kgs of food grain, the subsidy burden of 5 kgs will fall on the shoulders of the center. If the state wants to distribute 10 kgs, let them do it. But the burden on the center will be only for 5 kgs. Remaining 5 kgs, the subsidy burden will fall on the state government. And that is the reason the state governments play a very important role in the distribution of the food grains under the public distribution system. Now, I said there is an entitlement now. There is a legal entitlement provided to the beneficiaries. That is, the government of India introduced the bill in the name of National Food Security, and after passing this has implemented the National Food Security Act. Now, what is the meaning of the food security here? What does it actually mean? Food security will essentially mean that the government of India is ensuring there is food grain availability in India. Food grains are accessible and the food grains are affordable. Availability, accessibility and affordability. If we can check all the 3 boxes, essentially you are providing food security. So, Government of India with the passage of National Food Security Act or the implementation of the Act provision is providing legal entitlement to the beneficiaries. Now, what are the important provisions of the Act? Point number 1, the government simply says 2/3 of the total India's population, 2/3 of total India's population would be covered under NFSA. And please understand, the population that I am talking about now will be the 2011 census population. The census population of 2011 has been taken. Should we restructure this? Of course, yes. There has been a lot of discussion surrounding this. Back in the year 2019, Niti Aayog held consultation, held talks regarding changing the coverage. Very recently in the Rajya Sabha, this issue was raised up by Sonia Gandhi ji. Right, in let's say 2022 as well, Supreme Court of India has raised concern regarding the coverage of population, because 2011 and let's say 2025, the population is completely different in India. So there is a need to change the population coverage, but for that to happen, we need to have population census, which was supposed to be done in 2021, which is not yet done, not yet conducted in India. So 50% of urban population would be covered, 75% of rural population. Overall population or the overall number of beneficiaries under NFSA will be 2/3 of the total India's population, and that comes out to be, that is the number of beneficiaries comes out to be around 81.3 crore people in India. Second one, these beneficiaries which are identified will be divided into two groups. Will be divided into two parts. One is called as a priority household. One is called as a priority household, that is PHH. PHH, and the other one is called as Antyodaya household. Antyodaya household. Right? Now, why this kind of a differentiation? The government of India earlier, that is even before the introduction of NFSA, had announced a yojana by the name of Antyodaya Anna Yojana. And if a household is identified as the poorest of the poor, they would be covered under Antyodaya Anna Yojana. They would be given a Antyodaya card, and these are issued with a certain number of food grains. Higher entitlement is provided. So what is the entitlement? For a priority household, now the entitlement is 5 kgs of food grains per person per month. And if you have a Antyodaya card, you will be provided with 35 kgs of food grain per month. Per month, you will be provided with the entitlement of 35 kgs of food grain. So Antyodaya card holders will also be covered under NFSA, that is National Food Security Act. Now, when these food grains are issued, until very recently, the government of India used to charge certain amount of money from a beneficiary. Issue price, although it was very less, but there was some issue price. For rice, 3 rupee per kg was charged. For wheat, 2 rupees per kg was charged. And for the coarse grains, government used to impose and collect 1 rupee in the form of issue price. But the introduction of Pradhan Mantri Garib Kalyan Anna Yojana, which was done by government of India during pandemic under Atmanirbharta package 2020, the government introduced the Pradhan Mantri Garib Kalyan Anna Yojana, where 5 kgs of free food grains were given in addition to the coverage under NFSA. Now the pandemic is over. Government of India simply said, you will not get entitlement under NFSA plus Pradhan Mantri Garib Kalyan Anna Yojana. This has been merged. Now 5 kgs of free food grains are being provided under NFSA. Done. So poorest of the poor will continue to be covered under AAY, that we have already taken care of it. There is a grievance redressal mechanism as well. That is, you are not getting the right quality and the quantity of the food grain, not on timely basis, etc. So at the state level, at the district level, officials have been appointed to address your complaints or grievances. We also promote usage of technology, usage of Aadhaar for efficient implementation of NFSA. We are already using that under the model called as One Nation, One Ration Card. The states have to identify the eligible beneficiaries or the eligible households. So these are certain very important points associated with the concept of public distribution system as well as National Food Security Act. Now associated with this, an MCQ. Consider the following statements regarding NFSA. There are 3 statements. How many of the statements are true? Just try it out. If you simply say, sir, what is the key answer? Right? Please tell me what is the right answer to this question. Do not worry. At the end of the session, I've given the key answers to all the questions which I've given for your practice here. Okay, let me go forward now. Next concept, balance of payments. Balance of payments. Now, what is this idea of a balance of payment? Simple. India is an open economy. And what do you mean by open economy? There are multiple transactions which are conducted between this country with the rest of the world. There will be transactions because of which capital will come into India, go out of India. Because of which, right, dollars because of imports and exports will come into India, go out of India. Remittances will come into India, go out of India, etc. So essentially, we need one authority which will maintain all the transactions which are going to take place between India on one side and rest of the world on the other side. The authority which will keep a track record of all the transactions is the Reserve Bank of India, RBI. And this record of all the transactions between India and rest of the world, this record is called as balance of payment. I'll start using the short form now, BOP, balance of payments. So in a nutshell, balance of payments is a record of all the imported transactions as well as export transactions. That is, those transactions which will lead to inflow of dollars into India and those transactions which will lead to outflow of dollars from India. That is called as a balance of payment. Now, according to IMF, the latest guidelines of IMF, the balance of payments are supposed to have three accounts. One is the current account, capital account, and the third one is the financial account. But in case of India, historically, despite RBI publishing third account as well, historically, we have been publishing only two accounts. One is the current account, second one is the capital account. Now, many of you will be confused between what is the current and what is the capital. Current account generally will consist of the transactions which are associated with national incomes. In addition to that, there is remittances, there are other transactions, but mainly associated with national income. For example, imports and exports. Whereas the capital account, the second one, will consist of all the transactions which are associated with the assets and liabilities. For example, the foreign portfolio investments that will come into India will invest in financial assets. FDI that will come into India will invest in physical assets. The borrowings that we do under ECB is a liability, etc., etc. So the assets and liabilities, the transactions are recorded under the concept of capital account. So far so good. Now next point. Regarding the balance of payment, please have a look at the export and import here. If the value of exports is greater than the import, we will call this as a trade surplus. And when you talk about trade, there can be a talk about merchandise as well as services. That is basically the goods and services. So when you talk about trade, in case of trade, India has a merchandise trade deficit. That is essentially the value of import of goods is greater than the value of export of goods. Services, we have a trade surplus. Overall, we have a trade deficit. But again, please understand, it's not that always India has a trade deficit. There have been certain instances where we have enjoyed a trade surplus as well. Next one is the current account. If you take the total current account, if the income in the current account is greater than the expenditure under the current account, that is called as a current account surplus. If it is vice versa, that is expenditure side is greater compared to the income side in the current account, that will be called as a current account deficit. And those who are finding it very difficult, sir, what do you mean by surplus? What do you mean by deficit? Simple, my dear. If you take the sum total of all of these parameters, all these numbers, if you take the sum total, imagine the sum total turns out to be, let's say, $100 billion. That is $100 billion are coming into India. And when you look at the overall outflow of dollars under the current account, let's say this is $120 billion in the context of India. So what does it mean? I am receiving $100 billion. I am paying $120 billion to the rest of the world. It essentially means there is excess outflow of $20 billion from India. This is deficit, current account deficit. So traditionally, has India experienced a surplus or a deficit? You will see that for a lot of time, India generally experiences a deficit in the current account. And in case of capital account, we enjoy surplus. We enjoy surplus in the capital account. For example, can you connect it to current affairs now? Static is getting basically integrated into current affairs. For example, let's say if UPSC will give you a statement like this, with the recent announcement of increased FDI for insurance sector and space sector, which of the following accounts in the balance of payments would be affected to a larger extent, or which of the, right, let's say accounts will be immediately affected, immediately? Then you will have to basically say, first the company will bring in money into India. Because I know many of the students will say, sir, imagine, right, let's say space sector production will be done in India. Import dependence will go down, which means it will have an impact on current account. But that will happen later. That will happen over a period of time. Immediately, what is going to happen? The space sector is going to attract a lot of foreign direct investment. And when foreign direct investment will be done, can I simply say immediately that will have an impact on the capital account? So I hope you understand the argument here. In case of capital account, we enjoy a lot of surplus. And this particular surplus, many of the times, is sufficient to address the deficit within this particular concept of a current account. Okay, right. So these are certain very important points regarding BOP, balance of payments. And many of the times, you might end up borrowing from IMF. Imagine, you will end up borrowing from IMF, International Monetary Fund. Why? You have a lot of deficit. You have exhausted all of your forex reserves. Even then, there is a deficit in the BOP. In such cases, that is when you face the BOP crisis issue, you run to IMF, you borrow from IMF. Please understand, there are multiple transactions which can be conducted by the countries to stabilize the balance of payment. So whenever you look at the transactions in the BOP, you can divide them into two types now. One more classification. You can divide them into two types. One is called as, right, accommodating transaction, and the second one is called as autonomous transaction. What is autonomous transaction? Any transaction that are being conducted independent of status of BOP. Anything that is economically driven, that is a profit driven, etc. For example, let's say remittances. It is conducted, that is inflow and outflow of remittances is independent of status of BOP. Or for that matter, let's say imports and exports. These are independent of status of BOP. But on the other side, if RBI will conduct the sale of official reserves, that is, let's say, because of the deficit in the BOP, RBI now will be forced to sell dollars in the market to ensure sufficient dollars are there. Can I simply say this transaction is being conducted to stabilize the BOP, to address the situation in the BOP? That is, right, accommodating transaction. On the other side, if Government of India will borrow from IMF to stabilize the BOP, that is again accommodating transaction, right? So autonomous and accommodating transaction, again associated with the concept of balance of payments. Now question number 2, how many of the following are part of the autonomous transactions of balance of payments? I have given you four examples here: exports, imports, FDI, and Indian government borrowing from IMF. How many of these are autonomous in nature? Do let me know. Now let me go to the next concept, Government of India bonds. The G securities or Government of India bonds. Now listen to me very carefully. Government of India annually announces a budget. Very recently, on the 1st of February 2025, budget for the financial year 25 and 26 was announced. But when the government announces a budget, generally what you see is the expenditure announced by the government, the expenditure that would be incurred in a particular financial year would be greater than the sources of income. Sources of income, mind you. That is how much money is being earned by the government. It is smaller or lesser compared to how much money is being spent by the government. And this essentially will lead or will force the government of India to borrow from the market. It will force the government of India to borrow. Now, the borrowing can be done in the domestic market. The borrowing can be done from external market as well. It can be done from the domestic market, can be done from the external market. And this is not just applicable to Indian government, it is applicable even to the state governments. Even the states will have a huge amount of expenditure compared to their income. They are also forced to borrow from the market. So now come back to the point here. Central government can borrow from the domestic as well as external market. Whenever they borrow from the domestic market, this will be counted as a part of internal debt. Internal debt. That is, you have borrowed from the domestic market, you will have to repay this internal debt. When you borrow from the external market, for example, you have taken a loan from World Bank. You have taken a loan from BRICS Bank, Asian Development Bank, etc. That is called as external debt. External debt. Now, whenever you talk about government borrowings, one important way through which the government borrows is by issuing instruments. Government will issue multiple types of instruments with different tenures, a different maturity period to borrow from the market. And please understand, these instruments can be divided into two types. One is called as a treasury bill, second one is called as a dated security. What is a treasury bill? If the instrument that is issued by the government of India will have a maturity period of up to 1 year, 91 days, 182 days, 364 days, those instruments are called as treasury bills. On the other side, if the government of India will issue bonds which will mature in 10 years, 14 years, 50 years, 40 years, etc., these are called as dated securities or else government bonds. These are also referred to as government bonds. So please be very careful. Treasury bills are not government bonds. Dated securities are government bonds. And generally, any instrument which has a maturity period of more than 1 year, right, and it is used to borrow, we call it as a bond. General convention, okay. So government bonds more than 1 year, the idea of a treasury bill less than 1 year. And remember next point as well, treasury bills are allowed to be issued only by the central government. State government cannot issue treasury bills. But then you will ask me, in that case, how will the state governments borrow if they want to borrow for a shorter duration? There is a OD facility. There is a WMA facility, ways and means advances. So there are different routes for the state to borrow for a shorter duration. For a longer duration, that is more than 1 year, the states are allowed to issue bonds which are referred to as state development loans. State development loans, SDL, state development loans. And according to the data issued by the government of India, released by the government of India, for the first time ever, government of India started issuing 50-year government bonds. Remember this. For the first time ever, government of India from November 2023 has started issuing 50-year government bonds. In a nutshell, the highest tenure of a government bond now is 50 years. Until very recently, it was 40 years. Now it has become 50 years. Can be a statement asked in the preliminary examination. Be careful. Now, many of you will ask me this. Sir, what was the need? Why did government of India introduce this kind of a 50-year bond? Was anybody asking for these kind of bonds? Answer is yes. There are certain investors in the market who are called as a long-term investors. Insurance companies, pension companies, these are long-term investors. They prefer to hold their investments, that is essentially invest in securities which have a longer duration. And that is the reason Government of India has issued 50-year government bonds in the year 2023. Done? So these are certain very important points associated with the concept of government borrowing. Now based on this, I have given a question here. Consider the following statements. The treasury bills may be issued by the center and states to borrow for a shorter duration. The government has issued the longest tenure bond of 50 years for the first time in 2023. The government has borrowed using sovereign bonds in the domestic as well as external market. However, the latter is small value compared to the former. Now, let me help you regarding the third statement. Only the third statement I'll help you out. Has Government of India borrowed from the external market? Answer is yes. But has it issued government bonds outside India? Answer is no. Now somebody will say, sir, confusing. What you said, confusing. First statement, I agree. It was easy. But suddenly, because of the second statement, now I have a doubt over both of the statement. My dear, Government of India has taken a loan, let's say from World Bank. Imagine, Government of India has taken a loan from World Bank. Can I call this as external borrowing? Yes. But Government of India here has not issued a Government of India bond in the external market to borrow. So, is there an external debt? Yes, Government of India has external debt. But that is just around 5%. Remember this. Just around 5% of the total debt of Government of India. Just around 5%. But Government of India has not issued any bond outside India. All these bonds have been issued in the domestic market. All of them are rupee denominated. I am mentioning this because earlier in one of the budgets, there was a proposal. That is, Government of India will start issuing dollar denominated bonds. Right now, these are rupee denominated bonds. Whether a foreign investor will come to India and purchase, you will purchase or I will purchase, doesn't matter. These are issued in India. These are rupee denominated. Earlier, there was a proposal. I repeat, earlier, there was a proposal that they will issue these bonds outside India and in dollars. There was a criticism because historically, Government of India has not borrowed by issuing sovereign bonds outside India in a foreign currency, because there is a risk, exchange rate risk associated with that. Right? So, these are the three statements. How many of these statements are true? Do let me know. If you want to know the key answer, wait, I will give you the key answer at the end. Next concept, different types of deficits. There are 4 types of deficits which are calculated by the government now. You look at any of the budget documents in recent times, you will see only 4 types of deficits. One is revenue deficit, second one is effective revenue deficit, third one is the fiscal deficit, fourth one is primary deficit. Now, what is the meaning of each of them? Revenue deficit basically represents how much extra money am I spending under the revenue head of the budget compared to the revenue incomes or the revenue receipts that I collect. Now, those who are wondering, sir, what is this? Budget is divided into 2 sides or 2 accounts. One is called as a revenue account, second one is called as a capital account. The revenue account is further divided into 2 parts, same for capital account. What are the 2 sides in both revenue and capital? One is receipts, revenue receipts, and the other one is expenditure, that is revenue expenditure. Capital receipts, capital expenditure. This is essentially the division of the budget into different accounts. Basic difference is there is always a change in terms of assets and liabilities in the capital side of the budget. Whereas in case of revenue side of the budget, these are generally the incomes collected or expenditures incurred during the day-to-day activities of the government. During the day-to-day activities. And under this, there is absolutely no change in the assets or the liabilities of Government of India. So, first one is revenue deficit. You take the sum total of revenue expenditure, right? The total revenue receipts. What is the excess of revenue expenditure compared to revenue receipt? That is called as revenue deficit. Effective revenue deficit. Under the revenue expenditure, there is one component called as grant for creation of capital asset, GCCA, grant for creation of capital asset. And the grant for creation of capital asset is essentially an expenditure on creation of asset, but not by the center directly. Center will simply give this grant, that is money is transferred to somebody else, they will develop the infrastructure. That is called as a grant for creation of capital asset. So, to have a better picture, what we do is, in the effective revenue deficit, we are simply subtracting the grant for creation of capital asset from the revenue expenditure itself. So that we will basically now say, whatever is there under the revenue side, none of it is actually leading to change in the assets or liabilities. None of it is changing assets or liabilities. Done? Third one is fiscal deficit. Fiscal deficit essentially represents how much is the borrowing of the government in one financial year. I'll repeat the statement. How much is the borrowing of the government in one financial year is represented in the form of a fiscal deficit. Now, somebody will say, but sir, there is one more term called as a public debt. My dear, debt represents how much money you have to repay. Fiscal deficit represents how much money you have borrowed. Both are different. And those who are saying, sir, what you have borrowed, you will have to repay. Does it not mean the one and the same? What you have borrowed, you will have to repay. But my dear, fiscal deficit represents how much money you have borrowed this year. The debt represents how much money you have to repay, whether you have borrowed this year, last year, or 5 years ago. Doesn't matter. Right? So, fiscal deficit basically represents how much money you are borrowing in this particular financial year. Now, there is a fourth one, primary deficit, much more qualitative. Right? Much more qualitative data. Primary deficit. What is the meaning of the primary deficit? All of you will memorize the formula. I know a lot of you would have simply memorized the formula as given in the document, as given in a book. But what is the meaning of primary deficit? Imagine you borrow 100 rupees this year. How do you use this 100 rupee? How do you use? For what purpose do you use the 100 rupee? If you use 100 rupee to develop infrastructure, does it not mean your revenue generation capacity in this year is very weak? You are borrowing and using it for development of infrastructure. Why? Because you are not able to collect the revenue. Your revenue capacity is weaker. But on the other side, imagine you borrow 100 and you will use all the 100 rupees to pay for interest on the past loan. That is, in 2020, you have taken a loan, on that you have to pay interest. So, you will borrow 100, you will use the 100 rupee to pay interest. Now, tell me, because you have borrowed 100 and used 100 rupees for interest payment, does it not mean you are able to take care of your this year expenditure using your own revenue this year? You have generated sufficient amount of money this year to take care of infrastructure development, to take care of social welfare schemes, etc. That information you can derive using primary deficit. That is how much money you have borrowed and how much of this you are using for interest payment. The gap between this will basically represent how much is the borrowing you are using to take care of your current year expenditure. If it is smaller, it simply means your finances of this year are much more stronger. You are able to take care of your current year expenditure using current year receipts or incomes. Okay. So, based on this, question number 4 now. Which of the following will reduce the deficit in the budget? Selling dated securities, disinvestment, counter-cyclical fiscal policy during recession. Which of the three, or let's say, right, what is the right combination? Only one, only two, or one and three, etc. Which of these following can be used to reduce the deficit in the budget? Okay, this is question number 4. Next one, cost push inflation and demand pull inflation. Cost push and demand pull. What is the basic idea? Simple. Inflation means what? The price level for a basket of commodity is going up. Whatever is the price for a basket of commodity, basket means group. The price levels is increasing. That is called as inflation. Now, this rise in the prices can happen because of supply side factors, can also happen because of demand side factors. For example, let's say the Reserve Bank of India will increase money supply in the market. The loans, you can get these at very less rate of interest. You will take lot of loans, start purchasing vehicles, housing, right, etc., etc. On the other side, if the GDP grows very fast, more and more jobs are generated. More people are earning higher salaries. Higher salaries, higher disposable income. The government of India will reduce income tax rates, will give lot of exemptions so that the disposable income increases, demand for the goods and service increases. So essentially what examples I've given right now, using these examples, the aggregate demand, that is the total demand for the goods and services, will start going up. And when the aggregate demand goes up, it can lead to increased market prices. And that is essentially nothing but inflation. And on the other hand, the cost side factors, supply side factors can also contribute to inflation. For example, let's say the cost of raw material goes up. The government of India will increase, or the GST Council will increase the GST rates on these particular commodities. Or let's say there is a supply disruption because of unseasonal rainfall. Supply will go down, the market prices will increase. Petrol and diesel prices will go up. That will increase the cost of transportation, increasing the market prices. So when the supply side factors will contribute to inflation, that is called as cost push inflation. Now those who are wondering, sir, in India, which of the two are adding to inflation? Which of the two are contributing to inflation? Most of the times, both of the factors are contributing to inflation. But please remember this, according to Reserve Bank of India, it is mainly the supply side, that is the cost push inflation, which contributes to inflation compared to the demand pull inflation. And that is the precise reason the Reserve Bank of India will take policy measures to control inflation, but it can effectively control the inflation if it is on the demand side. Whenever it is a supply side factor, the more important role, or higher importance should be given to Government of India's policies, because the Government of India's policies can ease out the supply side issues which are contributing to inflation. Okay, done. Now based on this, I have given a question here. Which of the following are the causes of cost push inflation in India? Increasing cost of commodities in the international or global market, government reducing the income tax rates, unseasonal rainfall. Which of the following factors, how many of these, or let's say which of these combinations are contributing to cost push inflation? Let me go to the next concept now. Priority sector lending. PSL, priority sector lending. Now whenever you talk about functions of Reserve Bank of India, what are the duties or the functions of Reserve Bank of India? The most important function will be the credit control tools or monetary policy tools, right? Credit or monetary policy tools. Now, when you talk about credit control tools or monetary policy tools, you can further divide them into two parts. One is called as a quantitative set of tools. Quantitative set of tools, that is general set of tools. And the second one is qualitative. Second one is qualitative or specific set of tools. Now, in case of qualitative, the most important tool is the concept of rationing of credit. Rationing of credit. What do you mean by rationing of credit? Distribution. How the credit is distributed, how the loans are distributed, that is called as a rationing of credit. And the tool that is used to ensure there is a rationing of credit is priority sector lending. PSL, priority sector lending. Now, what does the priority sector lending essentially mean? Reserve Bank of India has notified the following areas wherein the banks will have to ensure certain percentage of their loans will be given to these areas. Certain percentage of the credit issued has to go to these particular areas. That is essentially called as, right, the rationing of credit using priority sector lending. Is it the same for all the banks? Please understand, although the books will say PSL target is 40%, whether you are a foreign bank or a domestic bank, PSL target is 40%. Yes, but is it the same 40% for all the banks? No. For example, if you are a small finance bank, SFB, if you are a regional rural bank, RRB, in such cases, the PSL target is 75%, not 40%. And what are the areas? What are the different segments which are covered under PSL? You have MSME, micro, small, medium enterprises, agriculture, export credit, right? You have the weaker sections of the society. You have social infrastructure, renewable energy, etc., etc. So, multiple areas are covered under the concept of a PSL. Please be very careful. This has been there in the discussion, and traditionally as a static concept, this is very, very important. Now, based on this, a question has been given. Consider the following statements regarding priority sector lending. PSL is a qualitative monetary policy tool. Banks failing or falling short of the target may use a PSL certificate. PSLC means PSL certificate to meet the targets. It is the same for all the banks in India. Right? How many of these statements are true? How many of these are correct? Do let me know. Next concept, GST, goods and services taxation. Now, what is this idea for goods and services taxation? Listen to me carefully. The taxes generally can be divided into two types. One is called as a direct tax, example, income taxes, corporate taxes, etc. And the other one is indirect tax. Indirect tax. Right? The best example for an indirect tax is a GST. Now, those who are thinking what is essentially or the fundamental difference between a direct and indirect tax? What is the fundamental difference? The fundamental difference is that in case of direct tax, the burden of taxes cannot be transferred. The burden of taxes cannot be transferred. Technically speaking, they'll say incidences and impact of tax is on the same taxpayer, same person. For example, if I am earning income, Government of India will impose income taxes on me. Who has to pay the income taxes? I will have to pay the income taxes. Can I ask my father? Can I ask my mother? Or can I ask you people to pay income taxes on my behalf? You will simply argue, sir, you are earning income. Why should we pay? We are here to simply learn concept from you, not to pay your income taxes. You have earned income tax. You have earned income. You pay the taxes. Why should I bear the burden? You're absolutely right. So, the government has imposed a tax on me. I will have to pay income taxes. I cannot transfer the burden of taxation. Whereas, instead of this example, let's take another example. If I'm a shopkeeper, if I own, let's say a warehouse, or if I own, let's say, a shopping mall, you will come to me, you will purchase a good. government has imposed GST on me, I will transfer the GST burden to you. Then you cannot simply tell me that you will not pay GST, you will have to bear the burden of GST. So indirect taxes, tax burden can be transferred. Direct taxes, tax burden cannot be transferred. Now, in case of indirect taxes, from 1st July 2017, the government of India has introduced a very important reform by the name of GST, Goods and Services Tax. What are the important features? This can be asked in the preliminary examination. Point number 1, we have a dual model of a GST. Dual model essentially means every GST is divided into two parts, CGST and SGST. CGST will go to the center, SGST will go to the state where consumption happens. Please remember, SGST will go to the state where consumption happens. That is essentially, it is a destination based taxation. Destination based taxation. At point number 2, to introduce a GST, the government of India had to amend Indian constitution. Reason being, we are taking the indirect taxation from the center as well as the state, which are given to them under the Constitution of India. So we had to amend the constitution, and only then we were allowed to implement GST. Point number 3, to implement GST, to have GST rates, to include, exclude, decide the rates, disputes, etc., we have a GST council. We have a GST council, which is a constitutional body. I repeat, which is a constitutional body, which is set up under Article 279. And this particular constitutional body, that is the GST council, will have representation from the center, finance minister, will have representation from the states. The finance minister is the chairperson of the GST council. The role of the GST council is to basically take a call on all the issues related to GST. But mind you, whatever are the recommendations of the GST council, these are not binding on the government of India. These are not mandatory to be followed by government of India. Now, whenever you talk about GST council, there is a decision making process there. Either they will take a call based on the consensus or they will go for voting. And whenever you need to get something passed in the GST council, you need at least 75% of present and voting. The majority has to be at least 75% of present and voting. 1/3 of the total votes are given to the center, 2/3 is given to the states. Done? So these are certain very important points regarding the goods and services tax. So far, more than 40 types of indirect taxes at center, state and cessors have been submerged or subsumed under the ambit of goods and services tax. Whenever it is intrastate trade and commerce, next point now, whenever it is intrastate, intra means within the same state, we simply use GST. If it is interstate trade and commerce, that is between one state to another state, we use the term IGST, integrated GST, integrated GST. Done? Right. So these are the most important provisions or the points associated with the model of the indirect tax reform, that is goods and services tax. Now, based on this, I have given a question here. Question number 7, consider the following regarding GST council. It is a constitutional body set up under Article 280. The recommendations of the council are binding on the government. The chairperson of the council is the Prime Minister. How many of the above statements is or are true or correct? Next one, concept of savings, investment and capital formation. Okay. Concept of savings, investment and capital formation. Let's start now. What do you mean by savings? Imagine I earn income of 100 rupees. Out of this income of 100 rupees, let's say I'll pay 10 rupees taxes to government of India. So my income will be 100, but my income which I can spend, that is the disposable income, will be 90 rupees because the 10 rupee is the tax. So essentially remember this, if the government can change the taxation, the disposable income can also change. Let me connect it to current affairs announcement. The government of India very recently in the union budget presentation has announced that the middle class household will be allowed nil payment of taxes. That is, they will be given a larger relaxation, that is a rebate will be provided if your income is up to 12 lakh rupees. Earlier it was 7 lakh rupees. If your income is up to 12 lakh, a rebate will be provided. Now just understand the logic here. If a rebate level is increased or the threshold for providing rebate is increased, can I simply say disposable income in many of the households will increase? At least those households which have, right, let's say income up to 12 lakh, that will increase the disposable income, will lead to higher savings, higher expenditure, will contribute to growth in the economy. That is the argument which has been introduced by the government here. Okay, so out of total earnings, how much of the money I will spend is called as expenditure. How much money I will reserve it, I will not spend now, I will reserve for future expenditure is called as savings. That is called as savings. So imagine out of 90 rupees, if I basically spend 40 rupees and if I save 50 rupees, for what purpose? Future expenditure. This 50 rupees is called as savings. Now this savings can basically lead to investments. How so? Imagine I'll take 50 rupees, go to a bank, deposit the 50 rupees. Now this is called as a financial saving. Remember this. This is called as financial saving. Why? There can be one more type of a saving, physical saving. That is, I will use 50 rupees to invest in land, to purchase gold, etc. That is physical assets. That is called as physical savings. But to promote growth in the Indian economy, to promote higher growth in the Indian economy, you require more and more financial savings. I will save, I will deposit in the bank. Bank will give this as a loan to a company. The company will purchase raw material, machinery, hire people, produce more goods and services, supply them in the market. That will increase the supply on one side, higher employment means higher demand on the other side, and that will help us in promoting recovery, higher GDP, etc. So that is essentially the idea of a promotion of savings and converting that into investment. Now there is one more term called as capital formation. What is this idea of a capital formation? Always remember this, capital simply means something that has been produced by humans. I'll repeat this, capital is nothing but asset, but assets are not naturally occurring. You will not get a manufacturing facility in nature. You will not get, let's say, a machine in nature. I hope you understand, this is produced by humans. So the asset that is produced by humans, which will get added to the system this year, is called as capital formation. That is essentially to the existing, let's say, machines. I'll take example of machines. To the existing number of machineries in India, how many more machineries am I purchasing this year or this quarter? Am I adding to the existing, right, let's say, pool of capital? That is called as capital formation. And the formula for capital formation, right, or let's say, how do we calculate capital formation? Simple. What is the investment? And again, I reiterate this, investment basically means how much money out of the savings will become financial savings. How much of this will be used for acquiring assets? That is essentially called as investment. Because if I have, if I save 50 rupees and if I use 20 rupees in the form of physical and 30 rupees in the form of financial, total savings is not my investment. My total savings is 50, but my investment, that is adding to the capital formation, is simply 30 rupees here. Right? So please be very careful. So argument is how much of your investment or how much of your savings is becoming investment as a percentage of GDP, as a percentage of GDP. That is called as capital formation. Investment divided by GDP into 100. Now, whenever you talk about capital formation, there are two types. Capital formation, there are two types. One is essentially GFCF and the second one is stock. Now, before you start typing, sir, what is GCF? GCF stands for gross capital formation. What is GFCF? Gross fixed capital formation. Now, many of you will basically say, sir, is there any difference between gross fixed capital formation and gross capital formation? Yes. And many of you will be under the opinion that gross fixed capital formation simply means when you use the money to purchase a fixed asset, it will be called as gross fixed capital formation. You are absolutely, completely not correct. Completely not correct. There is some other element as well. Now, let me start. Whenever you acquire capital, that is assets, in 1 year, I'll call this as gross capital formation. Now, this acquisition of the assets can be divided into two parts. One, where you acquire the capital, but you do not keep on spending money on day-to-day basis. These are durable assets. For example, machinery. For example, manufacturing facility, etc. So, you do not keep on spending money on these assets on day-to-day basis. You purchase machine, you will use it for 10 years, 20 years. But on the other hand, you will purchase a certain assets, right, that will require your expenditure on, right, let's say recurring basis. You will have to keep on spending money on day-to-day basis. For example, purchasing raw material, purchasing unfinished goods, etc. That is essentially stock here. Right, so one is GFCF, second one is stock. One is a durable, second one is a non-durable, where investment money has to be spent on day-to-day basis. So, this is essentially the concept associated with savings, investment and capital formation. Now, regarding this, a question here. Consider the following statements. The savings in the economy as a percentage of GDP represents capital formation. Higher reselling of machinery will lead to capital formation in India. If I purchase used machinery, does it add to capital formation this year? There are two statements, right? What is the right answer? Try it out. Now, these are the various concepts as well as the MCQs that I wanted to discuss with you people in the second session of, right, let's say the Conquer Prelims 2025, the static portion. And these are the key answers for the 8 questions that I've provided. I hope all of you were able to solve the questions. Do let me know what is your view regarding these concepts and how many of you were able to solve more than 5 of these questions correctly. If you say, sir, I was able to solve 6 questions, 7 questions or all the 8 questions, it simply means your preparation regarding the static portion is right, very good. If you can solve 6, 7, 8, your preparation is very, very good. Done. So, this is what I wanted to discuss with you people in this particular session. If you like this initiative, do hit the like button. And if you're yet to subscribe to our YouTube channel, kindly do it right now. And again, to reiterate myself, if you need the PPT that I've used just now, you need to scan this QR code, join the Telegram channel. After the session is over, this PPT will be uploaded in the Telegram channel. That's it from my side. Take care. All the best. Prepare well.